Welcome to Mayor Brown's Tech Talks podcast. Each podcast is designed to provide insights on legal issues relating to technology transactions and keep you up to date on the latest trends in data, digital, outsourcing, and software by drawing on the perspectives of practitioners who have executed technology transactions around the world. You can subscribe to this series on all major podcasting platforms. We hope you enjoy the program.
In this podcast session, we will focus on the top 10 due diligence pitfalls for Fintech transactions. My name is Libby Raymond, and I'm delighted to serve as the moderator. I am the co-head of the Financial Institutions M&A and Fintech groups at Mayor Brown. My practice focuses on M&A for financial institutions at the intersection of technology, regulation, and financial products. I'm pleased to introduce my fellow presenters. Joining me today are my partners Nina Flax, Steve Kaplan, and Joe Pennell. Nina Flax is the leader of our Northern California Corporate Securities practice. Her practice focuses on M&A, joint ventures, and venture capital investments in technology companies. Steve Kaplan is a partner in Mayor Brown's Washington, D.C. office and co-lead for the firm's Financial Services Regulatory and Enforcement Group. Steve has extensive experience counseling financial institutions on the regulatory aspects of their purchases of fintech businesses. Joe Pennell is a partner in the technology transactions practice. Joe focuses his practice on digital and outsourced services transactions and is active in both fintech M&A and bank fintech partnership transactions. With that introduction, let's get started with the podcast. Nina, counting down from the top 10 due diligence pitfalls, what is pitfall number 10?
Thanks for the introduction, Libby. Pitfall number 10 is a failure to assess key value drivers. And I think this is all something that we feel is innate, but we think it's important to stress nonetheless, is understanding what the primary goal of a deal is. Is it the acquisition of technology or other intellectual property? Is it an expansion of a service or product offering, transformation of a business model, improvement of customer experience, hiring of talent, or is there some other key value driver? And so in thinking about this, we want to think about how you tailor due diligence considerations in different scenarios, like acquiring AI. So looking at acquiring AI, do you understand the core of the assets, the hardware, the software, the data that are material to the business? Your knowledge will influence your diligence and purchase agreement protections as well as post-closing action items. When you're diligencing the IP involved with an AI, where is the value in the algorithm? Is it using open source or third-party software? And, can you test the confidentiality protections? Where is the value in the data? Identifying the data and how it's both sourced and used. And, of course, you'll also want to review the processes and procedures for collecting, using, and disclosing and processing data, as well as confirm compliance with applicable data privacy laws. So taking this test case a bit further, test security and vulnerabilities, working closely with relevant technical experts. We need to be sure that we understand contractual rights and obligations that may impact the cost of any remediation actions we may want to take. You'll also want to diligence insurance coverage and consider putting in place additional coverage to fill any gaps. A cybersecurity incident, for example, could be covered by pulling together various policies: cyber insurance, general liability, technology errors and omissions, property and/or crime policies. And then as other considerations, is there any additional legal or regulatory compliance requirements that you need to be aware of? Have you thought about whether or not there's a CFIUS or other filing, outside of competition clearances that seem to be more top of mind? Again, asking all of these questions and tailoring the core of your diligence efforts to focus on the key value drivers for the acquisition. Libby, over to you for the next pitfall.
Thanks, Nina. Pitfall number 9 is the failure to define the target business and unbundle key assets. Defining the target's business and untangling key assets is a fundamental issue for both buyers and sellers. The definition of the business is a key term of an acquisition agreement. Once the business is defined, a buyer should ask some key questions. In a stock dealer merger, is the business being purchased all housed in the entity being purchased? In an asset deal, does the seller have all the assets needed to run the business, or does the buyer need to involve other sellers to get a full bundle of rights? How does the business appear in the financial statements of the seller or target? Where a startup acts as seller, determining which assets seller actually owns will be key. Where are these assets housed, and are the assets reflected in the financial statements? For larger companies, key assets such as IT or IP or master services agreements may be housed in an affiliate or the parent. Don't assume that seller has considered this in advance of the sales process. As a practical matter, seller may need to undergo an internal reorganization before closing can occur, and this should be built into the timeline and the acquisition documents. Where seller has a continuing relationship with buyer after closing, complicated contractual, technology, and operational issues can arise. Buyer or seller may not have all the assets or services they need after closing without an ongoing services agreement from the other party. This can potentially be more than a short-term transition services agreement and may need to comply with third-party vendor guidance published by the Fed and the OCC. The best approach will be to negotiate these arrangements at the same time as the main acquisition agreement and not leave this negotiation to between signing and closing. As a practical matter, it may only be possible to prepare a term sheet for these services and attach it to the acquisition agreement. Negotiation of the full services agreement will then be a condition to closing. Any term sheet like this should be as detailed as possible with key business and pricing terms included. Steve, over to you now for pitfall number 8 in our top 10 countdown.
Thank you, Libby. I'm going to talk about pitfall number 8, which is failure to prepare a diligence plan that addresses strategic and regulatory issues. It is critical that a buyer identify potential strategic value and regulatory risks before it prepares a diligence plan and begins its diligence. This will help ensure that an appropriate review is conducted to ensure that regulatory and legal issues don't impair the value of the underlying business or result in potential material contingent liabilities. This also saves time and money because it allows the diligence to focus on the most important items. Identifying strategic value obviously is different depending on key values as discussed by Nina. Identifying strategic value may require a contract and regulatory view. For example, where does the business generate revenue? One example would be a mortgage loan servicer, where a significant portion of its fees or revenue are generated by fees. Are those fees permitted under applicable law? Is the servicer required to pass the fee income onto its clients under its servicing agreements or pulling in servicing agreements? These are all very important items to consider early on in the process when designing your diligence plan. Another example might be whether the existing agreements of the buyer or target limit options. For example, are there exclusivity provisions in any agreements that would limit services performed or utility of the target? With respect to regulatory and legal risks, as we discuss later when we talk about misgauging materiality in compliance due diligence, it is important to consider liability risk, litigation risk, administrative enforcement risk, and reputation risk, both for you as the acquiring entity and the target. Finally, you should consider the current and future regulatory environment. While it's impossible to predict future legal requirements or enforcement actions, it's important to think about it and try to identify and assess the risks to the operation of the business and the value of the business. The type of business may also change the risks, including contingent liabilities. Let me provide a few examples based on different types of businesses and real-life examples. Let's assume the target is engaged in a consumer credit-related activity. Liability for violations of consumer credit laws will obviously be an important issue, but the business model and type of asset may materially change risks. For instance, is the product dependent on a non-traditional business model? Let's take marketplace lending as an example. Marketplace lenders frequently rely on bank partners to make and originate loans. The bank has the authority to exceed otherwise applicable interest rate limits. Well, is the bank the true lender if it's tested in litigation or an enforcement action? Do purchasers of the loans have the authority to impose validly contracted for interest rates? The Madden decision in the Second Circuit says no with respect to the ability of purchasers to impose interest rates. Has the target considered those issues? These are things that the plan should address. Another example would be for credit products that include the holder notice. The holder notice is required for transactions that are considered to be purchase money loans or contracts, like purchases of automobiles through a dealer or purchases of goods from a home improvement dealer. The notice provides that any claims that can be brought against the seller or the merchant or the originator can be brought against the assignee or holder of the loan or contract. Obviously, that means that those issues should be considered when designing your diligence plan. So, as you consider your diligence plan, make sure to identify issues that might be material before negotiating the term sheet, consider putting conditions in based on them, and tailor the scope and focus of the diligence on what's most important. I'm now going to spend a moment talking about misgauging materiality in compliance due diligence. A finding is material if it is likely to impact a buyer's assessment of the deal's value significantly. This is not just gating issues. A finding can be material if it affects deal structure, timeline, valuation, future plans, or other material terms. Materiality is something we recommend you continue to assess at every stage of the deal. What are the factors that should be considered when evaluating whether a finding is material? Contingent liability for the business is the first. This exposure could be administrative liability or class action exposure, such as from FinCEN or from the CFPB for most consumer financial services companies. For example, is the target subject to an investigation or examination? Consider what those potential consequences might be, which raises an important issue related to confidential supervisory information, which targets are generally prohibited from sharing under regulatory guidelines. Consider requiring the target to obtain approval or request approval if there is an investigation or an examination that would be confidential, but the findings could be material to the value or operation of the business. Other issues to consider from a materiality perspective include liability for the buyer itself. Generally, this is more of a concern for a merger transaction than a stock transaction, but it still is something to consider. For example, the CFPB argued in the Obama administration and pre-Kraninger era that providing investment capital that allows a company to engage in business activities may constitute substantial assistance. Another thing to consider is impairment in the value of the assets. Do the regulatory violations result in impairment or decrease in value of the business assets? An example could be the interest rate that's charged on the marketplace loans that I referred to before. Another item to consider could be business interruption risk. This arises in very different ways, and the biggest or the best example would be licensing. Licensing is something that should always be considered early and often, and if the company doesn't have appropriate licenses, it could both affect your timeline as well as your ability to affect the change of control requirements. In addition, you should look at future plans and regulatory relationships, and finally, reputational risk, which is more important for some entities than others. So, at the end, most importantly, follow your diligence plan, continue to assess scope and findings, and consider integration plans early in the process. Now I'd like to turn it over to Joe to discuss pitfalls number 6 and 5.
Thanks, Steve. Pitfall number 6 is failure to ensure technology and IP diligence is undertaken. Technical due diligence is important to detect latent technology issues and prevent overvaluation of a target. This diligence is primarily conducted by subject matter experts rather than lawyers, but consider reps and warranties in the purchase agreement regarding identification of material IT components, whether they are in good working order, and whether there have been any failures or breakdowns that have caused interruption or disruption to the business. Another key component of the technical due diligence process is an analysis of the open source code used in the target software. First, a disclaimer. Open source is used by virtually everybody and may not be a risk depending on how it is used, but you should understand what the target is using it for. The problematic open source licenses may obligate you to publicly share the source code for any software application that includes or even links to the open source software. Similarly, if you plan to integrate the target software with your own, that could require you to disclose your own proprietary software source code to the open source community. So what can you do as the buyer or seller to address these risks? Services like Black Duck or Veracode can analyze the software of the business and create a detailed report of all the open source components, what open source licenses may apply, and any unpatched security vulnerabilities in those components. From there, you can figure out how to address or remediate the risk through reps and warranties, technical remediation, or a reduced valuation of the business. In addition to the technical risks, a buyer needs to evaluate whether the target owns or has rights to use IP rights in its technology and domain names. You should verify confidentiality and invention assignment agreements were executed at the outset of employment and that they convey all IP rights developed. This is important to ensure there are no gaps in IP ownership or joint ownership risks. You should also verify that any joint development agreements allow you to commercialize, transfer, and exploit the IP without seeking consent of the joint owner and without accounting for profits. Is the target's technology dependent on licensed third-party IP? If so, you'll need to review the relevant licenses for any anti-assignment or change of control provisions that require the licensor's consent or that trigger termination rights for the licensor. All of this may depend on whether you are doing an asset or a stock deal. The more critical and irreplaceable the licensed IP is to the target's business, the more important it becomes to ensure buyer will have continued access to that IP. You should also review the target's involvement in current or past IP litigation to determine how much IP risk you are buying. Moving on to the next pitfall. Pitfall number 5 is failure to address customer-facing platform issues. This is a little broader than just diligence, but many companies are grappling with these issues right now. Increasingly, we see clients using digital platform technology to transform their front-end, revenue-generating, customer-facing business. Platforms can be many-to-many systems like Uber or Venmo, or they can involve a single company trying to reach many consumers. As one example, we're seeing multiple deals where a traditional bank white labels a fintech's lending platform or enters into some type of powered by arrangement with the fintech. Many of the issues in platform deals are pretty similar to ERP, SaaS, and other IT deals, but there are a number of unique platform issues and concerns too. Platform providers are in direct contact with your customers, which is atypical of most technology deals. Also, many platform providers are highly leveraged startups seeking rapid growth. This means that you're likely to have increased reputational, operational, and other risks to address in your contracts. These platform deals require strategic input and leadership from your digital strategy and corporate development teams, who have an enterprise-wide view of how the platform will fit into larger goals that your company is pursuing. That means your negotiating team may be different than a traditional tech services or sales channel deal led by your procurement team or your lines of business. So, what are some of the key risks and issues that you'll be facing? Once you've done the diligence to confirm that the platform provider is stable enough to be a long-term partner, you may still need some additional contract protections if the platform provider is a startup. Those protections might include regular financial reporting and termination rights if the provider's credit rating or other metrics drop below certain thresholds. You'll need the right to retrieve data in a usable format upon request and to get termination assistance so there can be a smooth transition to a replacement platform provider upon termination or expiration. Another big issue is legal compliance. Will the platform provider agree to comply with all laws applicable to your company or just those laws that apply to the platform provider? One typical compromise is to accept the narrower compliance commitment, but also make the platform provider responsible for violation of other laws resulting from the provider's breach of the agreement or its failure to follow your instructions regarding other laws. Another thorny issue is the ownership rights for developed IP. The parties need to consider who will own developed IP that incorporates both parties' sensitive intellectual property. If there are practical challenges in separating that combined developed IP upon termination of the contract, the parties may consider requirements to simply delete or destroy that IP upon termination. Depending on the circumstances, the parties may alternatively decide that both parties have ongoing rights to use that combined IP. There is no single right answer, which may depend on the circumstances of the deal. Finally, these platform providers are often in direct contact with your customers and prospective customers. The platform provider may find itself handling complaints received directly from your customers. That may require detailed complaint handling obligations that are consistent with applicable law and your complaint handling policies. You may also want to include a right to terminate the agreement if the platform provider behaves in a manner likely to adversely affect your company's reputation. Libby, over to you for pitfall number 4.
Thanks, Joe. Pitfall number 4 is lurking exclusivity, non-compete, and right of first refusal provisions. Smaller fintechs tend to have more hidden contract landmines than the average seller. These landmines include hidden exclusivity and non-compete provisions, as well as rights of first refusal and rights of first offer on the business being sold. Fintechs may lack negotiating leverage or be less concerned with enterprise issues early in their life cycle. In many ways, this is an M&A 101 issue, but just a lot more prevalent for fintechs than for other companies because fintechs may have been fighting to survive in the past. As a result, buyers should not rely on sellers to uncover these restrictions as part of the rep and warranty package. Sellers may perform very limited sell-side due diligence or be unsophisticated as to the effect of these hidden provisions. In addition, damages for breaches of reps and warranties may be capped at 10% or even lower and may not be worth much based on the creditworthiness of the seller. These restrictions could severely limit buyers' operation of the business going forward, or even provide a hidden last look for a third party to compete with buyer's deal. Out-of-scope contracts can be particularly troubling since they may not be part of the diligence package. One protection would be to ensure that the representations relating to no conflicts in material contracts are not limited to just the assigned contracts in the deal, but to any contract of the seller. Buyers are not immune either. A buyer needs to assess if there are any of its own agreements that would limit its ability to operate the fintech business after closing. Joe, back to you for pitfall number 3 in our top 10 countdown.
Thanks, Libby. Pitfall number 3 is inability to assess data privacy compliance and cybersecurity risks. Cybersecurity and privacy diligence were sometimes an afterthought in M&A transactions, but that is no longer the case given the impact on recent transactions. Buyers should be concerned about data privacy if the target company collects any personal data from customers or employees, especially across borders. If the target hasn't been compliant, the buyer may be at risk for regulatory actions, lawsuits, and reputational damage. Cybersecurity is particularly important if key assets of the target company include intellectual property or other non-public data, including know-how, customer lists, or personal data. Data breaches can materially undermine the value of a target company, the viability of a transaction, or the productivity or goodwill of the organization. If you're a seller, your purchase price may be impacted by a breach. If you're a buyer, you may be buying a class action lawsuit or a regulatory problem if there is an undiscovered breach or you failed to conduct adequate diligence. Personal data breaches, while drawing the most public attention, are only one type of cybersecurity risk. Some of the most serious malware and ransomware threats don't target personal information or data at all. The target may have undetected vulnerabilities to ransomware and malware. As part of your integration with the target, your own systems may be exposed to those threats. Some of the bigger topics to address in due diligence and during negotiation of the purchase agreements, reps, and warranties are as follows. Does the target have a current written information security policy that they've materially complied with? Have there been any data breaches? It may be worth engaging a third party to review the target systems for evidence of undetected data breaches. We have had clients that decided not to proceed with an acquisition based on evidence of network intrusions uncovered by a third-party review. Has the target complied with privacy and data protection laws, including in relation to consents from data subjects? Can the target lawfully transfer the personal data to the buyer at closing without violating the privacy policies that apply to that data? This is just a sample of the issues that you should be thinking through. Steve, back over to you for pitfall number 2.
Thank you, Joe. I'm going to talk about pitfall number 2, which is failure to ready a fintech business for regulatory scrutiny. This requires looking forward at the operation of the business post-closing. One of the major oversights we have witnessed again and again is the failure to consider the regulatory requirements that will apply to the business after closing. So what are some of those items? The first is a compliance management system, known as a CMS. Many fintech companies don't have a CMS like a bank would have. That's not surprising and actually consistent with regulatory requirements of the Consumer Financial Protection Bureau, which says that a CMS should be appropriate for the size and complexity of a company's business. Well, the flexibility may not apply to bank owners, especially for a majority-controlled subsidiary. Implementing a CMS can be costly, both in terms of dollars spent and impact on the business. The dollars may be predictable, but business impact is more difficult to predict and something that's very important to consider. Here are some examples. A CMS may require additional staff. A CMS will require processes for making and implementing business decisions, particularly those that trigger regulatory requirements. Will the owners be able to follow processes, the operators? Will processes result in extended timelines for implementing new initiatives, which is typically inconsistent with the operation of a fintech? Another good example relates to vendors. Will material vendors of the target pass regulatory scrutiny? Will the target pass scrutiny if it will act as a vendor to the bank? On March 5th, just last week, the OCC issued a revised set of FAQs designed to supplement OCC Bulletin 2000-29 on third-party relationships and risk management guidance. The guidance includes some very important considerations to think about when you're working with or investing in a fintech company. Another very important item for post-closing is the culture of the company. For example, sales practices and marketing materials. We frequently find that sales practices at fintechs are inconsistent with bank-required practices. For example, incentive compensation may not be consistent with the bank's program. There are ways to make it work, but it requires considering options, careful planning, and implementation. Now over to Nina for our final pitfall.
Thanks, Steve. So our final pitfall number 1, a failure to understand and maintain incentives for top innovators. The ultimate success of a transaction may hinge on your ability to identify, retain, and motivate top performers of the acquired business. Sometimes continuity can be key to unlocking the value of a transaction, or, the top innovators at the acquisition target can help to disrupt other areas of your organization. So when thinking about how to motivate and retain these top performers, consider retention bonuses or other financial incentives that may work well in the short term, but let's all be aware that they tend to only be effective for 1 to 2 years following the closing. How can we help to prepare? Well, there's some pre-signing steps that might assist. Identify the key employees needed in the short term to help transition the business and the employees that are needed for long term to drive growth. Try to structure your compensation packages to fit those particular situations. It's not a one-size-fits-all. Evaluate whether your top talent will thrive within your larger organization. Some innovators might just be not a great fit within your organization. So think about your core values and whether or not they align with those top talent. Try to identify any special benefits that's provided by the target that may need to remain in place even after transitioning to your standard plans. And think about the first impressions that you're making when you're approaching these compensation discussions. First impressions can really matter. It's also key to understand what can drive employee dissatisfaction post-acquisition. Is there a change in the culture, right? Are you taking a small, nimble startup and trying to force it into the layers and protocols of a global organization? Were the expectations for the acquired business perhaps too high at closing and need to be adjusted? Is there a sense for how the acquired target fits within the organization's broader strategy? What can you do to strengthen that message? Is there any sense of lack of opportunity to advance within the larger organization? And what does the communication process look like? What access does the target and its top talent have to higher-ups within your organization? So thinking about those things, there are some clear, easy steps that any buyer can take to promote employee satisfaction. Communicate. Communicate why the acquisition is strategically important and how it fits in the broader organization. Provide opportunities for, the acquired talent to be exposed to other areas of your organization. Provide easy lines of access to your management and clearly define what it takes to succeed and advance within the broader organization. Educate the transferred employees on your history, your other business units, your core values, your strategy, your path forward, and provide training and development opportunities. I think that takes us to the end of our top 10 pitfalls.
Thank you, Nina, Steve, and Joe, for your thoughtful analysis. If you have any questions regarding this podcast, please send them to Patty Holland at pholland@mayorbrown.com. Patty will forward your questions to the appropriate presenter. Thank you, listeners. This concludes our podcast. Thank you for participating.
We hope you enjoyed this program. You can subscribe on all major podcasting platforms. To learn about other Mayor Brown audio programming, visit mayorbrown.com/podcasts. Thanks for listening.